I don't think they're ready for it, but they're ushering it in.
We talk about the central bank and how, they know what's going on. They've been planning this. Now, what's funny about this is that we haven't had many presidents contradicting the Fed, but Trump contradicted the Fed, talked about the interest rates, also blamed them. If the economy comes down, it's your fault. We've never, I don't remember, maybe Kennedy or Reagan was the last two presidents that actually went out and contradicted the Fed. And he's purposely pointing the finger. I think he knows that the Fed is responsible for all of this. Do you think he's going to be going after the Fed, after the central bank?
I think what is most likely to happen, which is pretty typical during these periods of time, is that the government ends up taking over the central bank. And there have been slight repositionings in that regard since, I believe, 2009. So the Fed is not, in my opinion, is not as independent. But even if they were, they are a flippin' private bank. And how do banks generate money? And what is really their job? Their job is to protect the banking system. But the problem is yes, I'm fairly certain at some point during this crisis, he can't do it now, but during this next crisis, that the Fed it'll be obvious that the Fed is supporting government policy, just like it is in many of the other hyperinflationary countries that we're looking at. Venezuela, India is battling right now, but, probably it'll succumb as well. But there are a lot of countries that are dealing with that, and it really won't be a good thing. It's not a good thing whether they're part of it or not part of it. But it won't be a good thing when that happens. It's just an indication we've ratcheted up to the next level.
It's very interesting. You mentioned independence, and there was an article about the central banks where they're very worried about governments and the people questioning their independence. And at this point right now, they're really looking out and seeing. We're seeing what's happening in France and everywhere else. So I'm sure they're very worried because all eyes, I think, right now are on the central banks. If the entire global system comes down, they don't have an event to cover it up at this point. So what do?
Well, hyperinflate, because, let's see, when these markets all implode, that's deflationary, right? That pushes prices down. That's deflationary. Right. There's only one way. One, not two, not 15, one, and that's with inflation, but their balance sheets are so bloated. What are you going to do? More QE? Yeah. But is it going to be effective? No, because they have no place to go with interest rates, but more negative. This is endgame. I'm sorry, but it is.
You mentioned inflation. And back when we came off the gold standard back in 1971 officially, we saw inflation then. They were printing a lot of currency. People's wages went up. I remember my father back in the 70s, all of a sudden he was making $5,000 and he was making then $10,000. Housing prices went up. Everything went up. But that was during a period of when we had very little debt. Interest rates were very high. Now we're on the complete opposite side. Interest rates are very, very, very low. Wages, not that high. And we have a huge amount of debt. If we get hit with inflation this time, how different is that going to look?
Well, that's the whole point. It'll look like, that was close to hyperinflation during that period. That was a transition off the gold standard. Now we're in another transitionary period. So that inflation will be the hyperinflation that will burn out whatever little bit of confidence people still, because it's the public that has the confidence in the currencies. It's not the banks or the central banks. They know the truth. It is still the public. And when you're talking about the central bank money, it is all about confidence in that entity as to whether or not they can remain in power. And this whole rise of populism, which President Trump is part of that populist movement, that is what threatens their power. It's not just their autonomy, it's their power, because whoever creates the money creates the rules.
Absolutely. Let me ask you this. I mean, people have been talking about the transition.
Yeah.
We talked about this before.
Yeah.
Is this going to be like a Mad Max type of scenario, or do you think there's safeguards in place for when the system come down? I mean, we saw it back in 2008 when it came down. People were shocked. People didn't know what was happening. Right. Everyone was like, wow, the economy was doing great, and all of a sudden it came down. This time around, how is it going to look for people? I mean, are people going to be shocked? Is it going to be that shocking?
Of course, it's always shocking to the public that is not paying attention, because this is not something that lies ahead of us. It is something we are already walking through, but we have blinders on. It's that normalcy bias. This can't possibly happen in the face of it happening. So it will be shocking, because right now, when you look at the stock market, we've been taught that reflects what's happening with the economy, but everybody should know that particularly since 2008, the stock market does not reflect Main Street. It reflects Wall Street. And it's been pushed up through all sorts of financial engineering, but it's also been coming down just because of its own weight. There, up until this point, has not been an influx of sellers, and that's the difference. That I just saw this, like when I was doing some work yesterday, actually, that the selling pressure appears to be increasing. So what's going to be shocking, number one, we're already seeing more flash crashes. A week ago, Tuesday, so not this past Tuesday, but the one before, when the markets went down 800 points, the CME halted trading over 40 times. Did you know that?
No, I didn't know that. Wow.
Exactly. Over 40 flipping times. These products are contracts. And in these contracts, they give them the ability to do anything they want. And this was happening without a massive selling. So what's going to happen when people get their statements, their quarterly statements, and they open it up and it doesn't look so great, and they start to sell? Because the end of November 28th, they had don't hold me to this number, but it was something like 635 billion outflows from ETFs. Now, keep in mind that ETFs are exchange traded funds. They are a derivative product, and the rise of the ETF was concurrent with the demise of the CDO derivatives. Okay. So they have not fully been tested. They have not been tested through a crisis. This is our next test, is what's happening with the ETFs. But because they do not have to pay out in cash, they have been granted a waiver. That's why most ETFs hold virtually no cash for redemptions, because they redeem in kind. In other words, they can create new shares, new ETFs, and think about how ETFs are created. They're created via demand. So people want to buy this special ETF. Okay, they make as many of those ETF shares as they want to. And then when people start to sell, that's how those shares are destroyed. Now, only authorized participants can redeem the shares. So you and I would not be an authorized participant. If you bought a share of any ETF, you are not an authorized participant. That's guys like JP Morgan and Wells Fargo and Merrill Lynch. Those guys, that's who the authorized participants are. So with all of those outflows, with all of those ETFs having been sold, then JP Morgan or whoever the particular authorized participant is on that ETF, they either got shares of a new ETF or they got shares in the underlying index or however they're being paid out. Chances are pretty good at the moment they're sitting on those excess shares. But what happens when they're forced to sell, when there's enough liquidations? So what's going to shock people, going back to your original question, is their inability to liquidate when that knife, the stock market knife, is falling. Trading will be halted. It's going to impact the banks, so all of the bail-ins will take place. Yeah, it's going to shock everybody because they don't see the underlying mechanisms. But we're all globally interconnected, so it doesn't really matter where the weak link is in that system. And Deutsche Bank and Commerzbank may be merging. Thank you. Okay. It doesn't really matter where the weak link is. It will be shocking in the speed because people do not understand that these markets are not liquid. If a lot of people want to sell at one time, you are not getting out.
So, I mean, if this does happen, you said, the banks would close because of the bail, because you mentioned bail-ins. So I'm assuming the banks would then close for.
Well, do you realize that last Wednesday after Tuesday's bloodbath, when the markets were surprisingly closed and the excuse was President Bush's funeral, but that was not a planned event. That was a surprise event in an attempt to calm the markets. So we just had a Wall Street holiday, even though that's not how they didn't spin it that way. But that is a fact. They were trying to calm these insane markets.
Are you saying that they used the funeral to close the markets?
That is exactly what I am saying. Yes, that is exactly what I'm saying. Look at all those trading halts. Look at all the volatility on these markets. And that was a surprise event. That was not a planned event. And do you ever recall them doing that?
No.
Thank you.
So you mentioned bail-ins, and we just saw the banks close down for this. And of course, people, even myself, were not thinking in this way.
Exactly.
Right. So they'll probably come up with another excuse when all this starts to happen.
Of course.
And you said bail-ins. You didn't say bailouts. So the bail-in documentation, that is still on the table right now, where the bank is going to go inside and take what they need.
Oh my goodness. Yes, indeed. In fact, you even get, if you're a bank, having bail-inable, oh my gosh, yes. Actually, since 2008, bank deposits funded about, don't hold me to this, but I'll be pretty close, about 25% of the bank's trading activities. Since the bail-in, deposits fund 48% of the bank's trading activities. So they have been working quite diligently. And look at all of the Wall Street banks that became banks, so they would have access to the Fed window. I mean, that didn't go away. Goldman Sachs has been working voraciously and they all have, on building their depositor base, just because it is much easier to bail this in, because deposits from normal people like you and me are classified as sticky. They are not likely to run. And if you don't run in time, you ain't getting out anyway. Look at Cyprus, look at Greece, look at Portugal, look at Ireland, look at Poland, look at England, look at Austria. I mean, the list goes on since the crisis. None of that went away. That showed you what it's going to look like, but worse.
You said something very interesting, and it just clicked with me, where you said these banks like Goldman Sachs and others became banks where they had access to the Fed window. They can take deposits in. And if you really go back in time now, it's like they actually planned for all of this. I mean, now I'm thinking about it. Now you can see, now, of course, it's easier to go from this point and look backwards than looking at the time, where all the, Goldman Sachs and others were becoming banks and they were taking depositors. Then they came up with the bail-in documents. Now, when you look back, you can see the progression and how they maneuvered their way into this position where they're able to protect themselves from the next crash. I mean, it's completely amazing.
Yes. And you know what Janet Yellen is worried about? The leverage loans. Corporations are leveraged as high as or higher than they have ever been. And since 2008, when interest rates were pushed all the way down to zero, and there was this reach for yield, people were trying to get more yield. They were not paying attention. So you have this massive rise of what they call covenant light. That means protections from whoever is loaning that money, because that's what you're doing when you're buying a bond or a leveraged loan or any of that. You're loaning that money, which means the protections for those people that are loaning that money, whether it's in your pension or your 401k or wherever it is that you're doing it, whether you realize it or not, you don't have any protections. Well, I can't say any. You don't have many protections. And that is the area that has grown massively. So, yes, I did a study years ago on the laws on the books pertaining to gold and gold ownership and confiscation and all of that. And I started from today, whenever I did that day, and I moved backwards. And you made such an interesting comment, Dave, because it's absolutely true, is with some hindsight, you can see, that a lot of these crises